please welcome Elaine Coughlan, co-founder and managing partner, Atlantic Bridge, Elodie Dupuy, founder and managing partner, Full In Partners, Stephanie Galantine Heller, managing partner and co-founder, Bootstrap Europe, and Bloomberg's Aggi Cantrill.
Good morning. So we're going to be talking about SVB today, but I thought a great way to start is essentially looking at how raising equity has become much more challenging over the last half year to year for a lot of the growth companies, not just out of Europe, but also out of the US. And so raising equity was getting harder since the middle of last year. And then in March, SVB's collapse sent shockwaves through the industry. And the question that I want to start the panel with is, as we're seeing the challenges, the core challenges that are being born out of an end to negative interest rates and what that means for this sector, is the party over for venture capital? And if you want to start, Stephanie.
Well, is the party over? Probably not, but it's true that last quarter funding of European startups have decreased by 12%. And that's a further 12% on top of already very depleted 2022 in terms of capital raising. And so it's true, it is very challenging right now for a startup to be able to raise money, and you add the SVB collapse on top of it. So really it's about the access to capital. So when some of the funds, and we're part of it, that have raised during despite let's say the crisis, are well placed to come and help the venture industry. But it's true that it is challenging.
And coming from the VC side, Elodie, I wanted to ask you as well. Elodie, unfortunately, can't be with us in person here today because of flight cancellations. But I wanted to ask you as well, when it comes to the context of what that means for VCs, how is it going forward where you're going to be allocating funds? Is there a change in the sort of sectors that you're looking at because of this?
So I grew up at a time that was in 2008, right, when the US was actually entering a recession, right? So we had a very strong focus at the time on fundamentals in businesses, meaning companies that were either profitable or had a path to showing profitability. What I saw in the last decade, maybe in the last 5 years particularly, was sort of an abandonment of that focus as companies were chasing sort of hyper growth for extended periods of time. What I think the collapse of SVB means is a lot of investors are going back to those fundamentals and looking probably with higher scrutiny today than they were over the last few years for businesses that actually have demonstrable proof of a profitable revenue plan and profitable growth. So that's a shift in focus that's happening more broadly in the industry. There have always been certain groups that have had that as part of their investment philosophy, but I think that's becoming more the norm. And the second component I'll add is there were a lot of entrants in the market in the last 5 years of groups that had either been very successful founders and suddenly found themselves with a large liquidity event and capital where they wanted to get involved in investing out of a personal passion. I think you're going to see a reversion to more professional, institutionalized investors who have a framework, who have a more repeatable investment strategy, that are actually going to continue to be active in the market. And some of these other profiles of investors that have been sort of popping up and prevalent over the last 5 years are likely going to fade away as they ride out sort of this downturn in tech funding.
And Elaine, do you think that that essentially means that this sector is going to be maturing over the next couple of years after this negative rate environment is no longer the case?
Well, I think negative interest rates have obviously meant there was a lot of loose money chasing, in some cases, speculative companies and proposals. There's a much more revision now back to the fundamentals, as Alan was saying there. You know, in Ireland here, we have one of the highest ratios of VC per GDP per capita in the world, where we'd be ranked in the top 5. We have a very strong pipeline of innovative companies, and I think the types of companies now, so the noise has gone out of the market. It has been tough, by the way, for the last 12 months, I'd say, for innovative companies, and it's just got tougher with the Silicon Valley Bank situation. But what we are seeing is companies with really deep, defensible, strong IP, fundamentally sound business models, great entrepreneurs, great management teams, are continuing to be able to raise equity and debt. So I think that's a really positive sign. But I wouldn't sugarcoat that the environment is definitely tough. We see that in the numbers that you mentioned, Stephanie, and it's the same in Ireland. Our last quarter numbers were significantly off, even though year on year we were flat, about $1.5 billion, 22 on 21. The last quarter was substantially off by about 60-70%. So that's going to feed through. Remember, these businesses are long term. We're investing for 5-year plus. So they tend not to be as impacted by, the interest rates today. And the types of sectors I would be very optimistic about. We've seen what's happened in the launch of generative AI, and that's going to have a massive impact on enterprise. That's just the consumer side of it. All businesses have to digitize. There's huge competition globally now, so the efficiencies you need from digitization. And then you get into things like semiconductors and quantum compute and cyber and medtech and precision medicine. So I think we're going to see, out of all of the funding that has happened, the funding cycle now in the future, we're going to see transformational companies, global champions emerge from that. But all of the noise and the Me Too's and the less fundamental, without a competitive advantage companies are going to find it really difficult and probably won't make it.
But when we talk about the noise, something that's interesting to look at in the sense of the technology that's really going to bring a lot of companies forward and a lot of businesses that potentially want to invest from outside these sectors. I think a fair question is also, is VC the only channel for these sort of companies? Because when I speak to people who work, for instance, in the deep tech sector, they say that often because they're looking at development that takes a lot longer than the average cycle for a VC, that maybe VCs are not always the best option for them, and maybe they're looking at forms of government funding or from corporates also looking to invest in startups as well. I would love to hear what you have to say about that. If we start with Elodie, perhaps.
Sure. I mean, we've seen a rise in corporate investing over the last, again, 7 to 10 years or so. And I think that's an excellent use case, right, of where it makes sense to have a longer term horizon. There are also a lot of innovative fund structures coming out, so evergreen type of funds. Sequoia sort of pioneered a continuation fund so that they're able to remain in their businesses much longer. There are also certain groups that have always been designed to be longer hold periods, so multifamily offices where it's patient capital to begin with, and there's not necessarily the same type of pressure to return on an IRR basis. So I do think that those alternatives have existed for a while, and in the ease of raising capital from VC that we've seen, especially in the last 3 years, where I think that we all acknowledge now that it was sort of the top of a bubble, that maybe have sort of kind of fallen by the wayside and wasn't the core focus for a lot of groups. But as those funding drivers start to dry up, I think it does create path and opportunity for other profiles of investors. So I do expect that you will see that. I do think, though, that use case is going to be fairly limited to specific types of businesses or specific industries. And so for a vast majority of folks that are playing in traditional software consumer traditional software and consumer businesses, you're still going to see a healthy amount of deal activity from VCs. It's just going to get concentrated back into a more professional landscape of an investor versus what we'd seen in the last few years.
Stephanie?
Well, you saw the announcement this morning of the 43 billion war chest by the European Union for semiconductors. So obviously it's true in terms of all the strategic sectors. In terms of innovation, you will see government step in and try to push innovation. I think what you see also with the generative AI that you mentioned is over just this quarter, they receive about 11 billion of financing in the first quarter of 2023. So if you look at generative AI, it makes every business more capital efficient. You need to recruit maybe less people. It doesn't mean that you don't need. We are not going to create new jobs that are different than the one we know today. But clearly, the progress in bioinformatics also makes some of the life science businesses less capital intensive. So it's possible that some of the companies also see their costs decrease and maybe won't need as much capital as they need today. So you can also imagine a different world where innovation is so fast that you don't need as long to develop it. You know, with the compounding effect of innovation in generative AI, every week it's so fast that 1 year in that area corresponds to 12 years of development of the world we've known in innovation before. So we might be in this world where everything is accelerating. And in this case, you know, for us as venture lenders, it probably means we also need to reinvent how we allocate funds to the startups.
I think it's probably a fantastic opportunity for the CEOs and the companies in the room, the market today. It's almost you have to put the head over the heart, though, because I think obviously in a world where we've inflation and rising interest rates, and you're trying to keep and maybe some softening in consumer demand, and you're trying to keep budgets, everybody's focused on burn and costs, that it's hard to invest also. But actually, that's the right thing to do in terms of some of these transformational industries, in terms of how they affect your businesses. And it's actually the best opportunity because we're no longer at peak. So what you typically see in these cycles, and I've been through too many of them at this stage, 2 or 3 of them, is the corporates leave the market. The CVCs leave. And I understand why, because of the issue that I just said, the focus on, you know, that's all hands on deck. It's actually counterintuitive is what we have to do and continue to invest. And now the markets are at prices, and the companies that you possibly, regardless even of price, that you couldn't have maybe get into, you now can, and it's an opportunity to try before you buy. And I think it's also an opportunity for M&A for a lot of corporates into some of these competencies that your business doesn't have. So it's a great opportunity to get talent, to get tech that is relevant to your business. So I would say that's a great opportunity. And VCs, we're a VC, but it's only part of it. We partner with corporates. I think government is really important here in Ireland. The IDA and Enterprise Ireland run the Disruptive Technology Fund, and that's all around funding corporates along with the Indigenous Irish companies together to do joint R&D and to do programmes. So the Irish government will actually help fund a lot of that kind of transformational technology with a view to getting that out to the market. And I think so. You mentioned the CHIPS Act, the European. If you count up everything Europe has done in the last 18 months, there's 1.5 trillion of government investing going into these strategic autonomous sectors of semiconductors, cyber, supply chain, manufacturing, digitisation, green, climate, sustainability. And we're doing the same here in Ireland, and I know in Britain with the Future Fund Breakthrough, and the French and the Germans. So I think for corporate, it's a huge opportunity to partner with government and with VC and private investors and debt. It's going to take the combination of all of this to fund the rollout of these deeper technology, fundamental technologies, and I think the corporates have to have an exposure to that as well.
And also, we were just talking about this backstage as well. When we're looking at corporates and their role in a startup ecosystem, there's also a question about these companies being quite green, quite new, and also being able to make sure that these companies can navigate times like, for instance, the downturn that they're currently seeing. And going back to SVB, I think that this is a really crucial point. There was a recent study that came out about the social media risks that SVB was exposed to, essentially because so many people in the startup ecosystem all have the same connections via LinkedIn, via Twitter, and that the concerns from within the industry were so quickly spoken out loud on Twitter, for instance, that became an ongoing risk. And I would like to know from all 3 of you, essentially, what that means going forward. When you're talking to the companies that you work with, are you more clear with them about what they should really be thinking about when it comes to how they communicate their own concerns? And is that something that's a risk, you think, to potentially other fintechs that could see a similar flight of capital like we saw with SVB? Do you
want to take that? I think the speed at how Silicon Valley Bank happened is still reverberating. It's still a shock to us. And, you know, the fundamentals of their business model was not what took them down. It was a treasury rate risk mismanagement. And what we have found, I suppose, from that, and as you said, the social media aspect, which kicked it all off. And, you know, if that can happen to 90 billion bank, it can happen, you know, to any business. So I think we have not yet worked out from a regulatory point of view what is the right response to defend against this, because that bank was taken down. It could have taken down the entire innovation ecosystem. It certainly would have been a massive existential hit to it in the US, but also in Europe. I mean, we had 35 companies, Irish companies and European companies, that were exposed to that in, you know, when it was almost too late to do anything. So I think if you're a fintech or you're a consumer-facing financing business, you know, there's that risk is still out there, and we saw it move from one bank, you know, kind of leapfrog from one bank. I think that eventually the regulators were able to put a firewall in terms of the response, but, you know, it came very close to being Armageddon. So I don't think we've yet worked out how we stop that from a social media perspective. But it would not just have had, it was not contained, and I guess what we have learned quickly enough, and we've learned that too big to fail, you know, is the same as, you know, too small to fail. You know, that doesn't exist either. You can't, you know, we can't have these. It's also interconnected, and of course the confidence hit is still reverberating. So investment is a confidence business, and I would say that both the equity and the debt side of the house has taken another big hit as a result of that.
And going to that issue of a lot of this also precipitated out of the US originally and then fed into Europe over the course of a 24-hour period or a bit longer. And so I'd love to hear what you have to say on that front, Elodie, from the US, how that played out and why you think there wasn't more reticence on the part of people to push their concerns so openly and publicly on social media.
So I think the other component of what drove the SVB collapse is actually concentration, right? So when you're investing, one of the key things that you want to do is diversify your risk. And SVB actually went the opposite direction and concentrated into the tech ecosystem and the startup ecosystem, which was fantastic when that ecosystem was in the middle of the longest bull run in, I think, history in the US. And so they benefited from that for a very long time. The flip side to that is that when you are intricately connected to one sort of self-sustaining system where you've got the VCs that are backing companies and the companies that are taking debt from SVB, and SVB is underwriting based on the VCs that are in the company and, you know, the financial profile of the company, that all starts to get very interconnected. And if one of those things starts to unravel, it will pull down the entire system. So I do think that SVB was particularly unique in their level of concentration in technology. I think the other component of what we're learning from all of this is it's tough to have the right framework for underwriting high growth software businesses. And this is probably far too much detail for this type of event, but generally, you know, as software shifted from a license maintenance model 15 years ago into cloud, the fact that it's now cloud and the fact that it's now sold on a subscription basis, that means that it's really hard to generate an EBITDA positive business, because as you're growing very quickly, you're signing 12-month contracts, but you're only recognizing 1/12 of that revenue up front. And so you'd have a natural phenomenon where you've got loads of companies that are actually phenomenal businesses with very strong economics, but they don't show EBITDA positive behavior. And so I think SVB was trying to figure out, how do you actually underwrite to that profile and extend the debt, because there's money to be made for the bank and for those who are investing in those types of companies. And for a long time, I think the proxy was, are they funded by other investors? And does that give us a level of security? And I think that's the part that sort of fell apart on SVB. And it was certainly, to your point, aggravated by the fact that folks were very rapid fire discussing, not just on social media. I'm part of a New York VC WhatsApp, and there were like 1,000 messages a second around everyone sharing like rumors that they were hearing and what they thought was going to happen next. And it does create a sense of more panic. The other component to this is actually, I think, on the shoulders of investors and helping their companies with treasury management. So we were fortunate. Most of our businesses had accounts across multiple different banks. Once we, saw what was coming, we were able to get in front of a lot of our companies and have them, sort of load balance their capital across all these different accounts. But I think that, treasury management is something that just hasn't been, again, a core focus for a lot of earlier investors. It just hasn't been something that needed to be a focus. And so I think you'll start to see private sector react faster on some of these components versus the broader sector, regulatory wise. And then in terms of how that impacts Europe, so, we were slightly different. Our European companies didn't have a lot of exposure at all to SVB. I think anytime you see an impact in the US, especially in something that's as sort of leading as technology, where the U.S. has been the pinnacle of tech and innovation, it does have a tendency to filter over into the European sector. And we've seen that just in our own pipeline. Historically, we've had 50+% of interesting opportunities coming out of Europe. And in the last probably quarter or so, it's been much lower than that. And I think that that's part of what we're seeing is that shift in confidence. But I think that's pretty temporary and should come back, in the next quarter or so. We tend to see it swinging back and forth. So I think we'll see that sort of normalize. But I don't expect the SVB impact to be much deeper than that in Europe, outside of everyone being a lot more aware of treasury management and having that as part of, the infrastructure that they bring to the companies that they're investing in and working with.
And just to wrap up, I wanted to also talk briefly about the prospect of venture debt and what that plays for the industry now that SVB, a big venture debt provider, has left the market. And speaking from the context of a venture debt provider in Europe, do you see SVB's departure as a potential opportunity, or do you see a downside from losing this big player?
I mean, SVB departure, they're not totally departed. HSBC obviously is stepping in. But I think what happened, you have a question, is it okay to give your deposit to a bank that, then will just lend you against, the same money that you deposited, right? And I think then you see that for the more entrepreneurial venture lenders like Bootstrap Europe, we don't have that issue because we have a standard LPGP structure. So when we lend, we don't ask for that money to come back on as a deposit. And I think for us, when you look at the numbers for Silicon Valley Bank, just in the UK alone, they were underwriting about 500 to 700 million a year. So it leaves a huge gap that we can feel. And I think it is an opportunity to also reinvent a little bit, the relationship with the VCs, etc.
And just as a final point from your perspective in Europe, what does the prospect of venture debt come in? What does that mean essentially for VCs looking to try and find runway for a lot of companies that are at the moment really struggling to find equity? Is venture debt just another option that they can tap?
I think it'll be hard for the companies to tap into the venture debt unless they've really strong syndicates equity. So equity is more important than ever now, because it'll be those companies that can secure equity will secure debt. They won't get the debt on their own. And then the other really important role is government. And I think we're very lucky here in Ireland with very active agencies like IDA and Enterprise Ireland, who actively invest off their balance sheets as well and come in. And we're seeing that actually across Europe. So I'm actually very positive from a European perspective what we're going to see come out of Europe, because you have that very strong government sovereign autonomy desire to own and invest, make sure this capability is here in Europe and these companies make it through.
Great, thank you so much to all our panellists. Thank you also for dialing in, and yes, I hope you all enjoy the rest of the conference.